Well, the vote on account or the interim budget has begun. It's scheduled to be held as usual on February 1st, 2024. And the reason, of course, that it's an interim budget is because we're also days away from the general elections, post which the newly appointed government will present a full budget. Now, despite that, it does not take away from the criticality of the interim budget. A couple of things we're closely going to be watching out for in the interim budget is first, of course, the fiscal deficit. Now, for FY24, the government had set a target of 5.9% of the GDP for the fiscal deficit, and it's likely to reach that target. What we need to be looking out for, of course, is what the trajectory is from here on for the government's fiscal consolidation path. Now, we have a target of 4.5% for FY26, so it's likely that the target for FY25 is likely to be somewhere midway, at about 5.2% of the GDP or at 5.3%. Another parameter we're going to be watching out for closely is the government's spending on capital expenditure. The government is expected to continue with its thrust on capex, but we'll also watch out for whether it's able to maintain the pace of growth that we've seen in the last couple of years. But for this and a lot more, we're joined by our panel comprising Kaushik Das, Chief Economist at Deutsche Bank, Rahul Bajoria, Chief India Economist at Barclays, and Oradeep Nandi, India economist at Nomura. Let's hear it from the experts. To begin with, Kaushik, I would like to start with you. What's the budget math for the ongoing fiscal looking like? We have seen capex stronger in the first half of the year. Subsidy spending has been a little more than was earlier being anticipated, but more or less we seem to be in line to meet the fiscal deficit target for the year. What's your takeaway?
Yeah, thanks. The budget numbers for this year is supposed to be, in line. So the fiscal deficit target that the government has given at 5.9% of GDP, we think that will be met. Obviously, there will be revised estimates presented, which is going to be different from the budget estimate. But if you look at the different pluses and minuses, there are many things on the revenue side where there will be upside. For example, the dividend that the government of India got from RBI that was higher than the budget estimates. Tax collection in some, components are running higher than, what you'd have expected. So I would say that, it's kind of not too difficult to meet the 5.9% fiscal deficit target. And that will form the base then to calculate for next year's fiscal arithmetic FY25. What I think is, the capital expenditure target that they've given, close to 10 trillion INR, it'll probably come closer to that. Probably 9.5 trillion would be spent. There would be some bit of, amount which may not be spent, and that may be used to balance the other spending that is required for subsidies, as you mentioned. But then overall, I don't see it as a big challenge for the government to meet this fiscal deficit target. Growth has been stronger than what we expected. Yes, we know that the nominal GDP growth will be lower at about 8.9% compared to the 10.5% budget estimate. But I think that's not going to be a challenge. If you look at the tax collection numbers, that's running pretty in line with the target or even higher in some components. So I'm pretty confident that the 5.9% target will be met. And then we can discuss about the FY25, what our expectations are.
All right. So, Rahul, coming to you, do you broadly stand in agreement with that? And are you also expecting fiscal deficit for this year to come in at 5.9%? Or is there a little bit of a chance for it to be somewhat, of course, in that range, but maybe at a 5.8%?
I think, there's an element of false precision if we say it's 5.8, 5.9. I think broadly, they are basically the same number. I think, as Kaushik rightly said, that the government appears to be very comfortably placed as far as the fiscal arithmetic is concerned. Despite having front-loaded spending quite a bit, especially on the capex side, we have not really seen any significant widening in just the rolling trends around the deficit. And given additional dividend payments from the RBI. It looks like that there will be savings, at least on the fertilizer side. Despite the fact that there's been variability in farming activity, there seems to be reasonable amount of consolidation bias, which is very much visible both in communication and in terms of ability to do that consolidation. So I think all eyes will be on what is the extent of consolidation that can be done for next year, right? So fiscal year 25. And if they do set a target which is a tad bit more aggressive, say 5.2%, I think that will be a fairly aggressive statement from the government about its intent to undertake fiscal consolidation. We are looking slightly at a lower number, 5.3%, which we think is more realistic. But then, if we do end up seeing, a bit more faster pace of consolidation next year, then it would probably underline the commitment to kind of reduce the fiscal deficit at a time when growth is good. So the need for counter-cyclical fiscal policy to turn a little bit more restrictive will kick in, right? And that builds fiscal space for the coming years.
Okay, Auradeep, so, given that, of course, the focus remains on the fiscal consolidation path going forward, whether or not we will be able to meet a fiscal deficit target of about 4.5% by FY26, and how much will that require us to cut back on in the next fiscal? What's it looking like? Do you think that we will see maybe less aggressive growth on the capex front? What's it looking like?
Well, so I think you make a very important point that the fiscal consolidation that will happen in the next budget will be contingent on how serious the government is about the medium-term fiscal target, which is actually no longer that medium term anymore because it just comes 2 years later. So if the government is looking at 4.5% of GDP, you need to achieve around 5.2, 5.3% of GDP by next year, ideally. Now, one thing to remember is that the government really ramped up capex this year. Probably as a percentage of GDP to sort of multi-year highs, it's not necessary that every year you hike RevEx by 30-35%. I mean, even if they hike by 15 to 20%, as a percentage of GDP, capex actually still remains elevated. The other thing to also consider is, you'll have elections in the middle of the year. And then after that, your spending will start post-elections. So there's also the question of, you need to, how much spend you can do in the overall year. So I think that, so there is a signature statement the government has made in the current budget of FY24 saying that, look, we are really committed to capex. We've kept it at a really high level. I think that broad direction is still going to be there in FY25. So capex, I think, is going to remain strong. RevEx, I think, is going to be interesting because even in FY24, the government's budget was a very economical 1.4% growth or so. And I think what we are tracking is around 3.5 or 3.6%, and which is very understandable. We were very skeptical at the start of the year when we saw such economical numbers. Now, the other question that comes in is, we've got elections coming up. What kind of things they announce in terms of sort of poll promises? Even if they do announce certain things, probably the bigger impact of that will come in forthcoming budgets because, there's just a small element of what you're going to be spending now. So I think on the RevEx side, it'll be interesting to monitor what they're doing. On the revenue side, especially for the taxation bit of it, I mean, look, direct taxes, it's been it's not only a 6, it's a ball that's sort of gone across the stadium this year. I mean, it's growing at almost higher than more than 2 times the rate of nominal GDP growth, which is not usual. I mean, usually direct taxes grow by around similar growth rates as the nominal nominal GDP growth. So another, I think, really very interesting to watch is what kind of assumptions they make on the direct taxes side, and also, of course, on the indirect taxes side. How buoyant do they see tax revenues next year? In terms of nominal GDP growth, we expect it to be around 10.5% or so, compared to 8.9% this year. So that should offer some more cushion on that front. So at this point, 5.2, 5.3% of GDP is very much doable. It depends on what their priorities are.
Okay, all right. So, Kaushik, what is your expectation? What's the nominal GDP growth that you're penciling in for FY25? And we have seen, like you've mentioned, on some fronts, robust tax collections. Do you expect that trend to continue into FY25 as well?
Yeah, so we are assuming the starting point of any fiscal calculation is the nominal GDP growth. So we are assuming that the government will kind of use 11% growth, nominal GDP growth to do the collections, to do all these calculations. So the tax collection also would be more or less in line with the 11% growth around those levels. Now, certain, components of tax could be, on the higher side or lower side, depending on how they, kind of performed in FY24. But overall, you should get about 11% tax collection, which should be, pretty good. Disinvestments have not performed that well last year, but then these things take time. So we might be lucky in FY25 and you could get those disinvestments happening. So that could help. Non-tax revenue has been stronger last year. This year also, the government may get more dividend from the government, from RBI. So that can also help. I think on the expenditure side, capital expenditure would be to the tune of 11 trillion compared to 10 trillion last year. So that would be about 16% growth, which would be good. Whereas revenue expenditure would be brought down further because during COVID times, the expenditure already increased. The base is very high, so there is space to reduce that revenue expenditure. So that probably would be shown at 3-4% or 5% growth, whereas the capital expenditure would be 16-17% growth. So overall expenditure would be about 7-8% growth at the maximum, which would be lower than the nominal GDP growth. Therefore, as a percentage of GDP, the expenditure side would be reducing, whereas on the revenue side, as a percentage of GDP, that probably would be increasing to around 9.4%, and therefore you could easily get to the 5.5 or 5.3% fiscal deficit target for this year, and then you need to do just 75 basis points consolidation in FY26 to get down to 4.5%. So I think it's quite possible. India's growth has held up much better than anybody would have anticipated, and when you have the support of growth looking good, and the quality of fiscal spending has improved quite significantly. That's something to note. We look at a ratio called revenue deficit to fiscal deficit that has come down quite significantly from the peak in 2021. The lower the ratio, the better. So the quality of fiscal spending has improved quite significantly with the government pushing capital expenditure more and cutting revenue expenditure as much as they can. The only risk is if something goes wrong globally, geopolitically, and that leads to oil prices going up or some kind of problem which requires government support at any point of time. Nobody can forecast all this at this stage. But otherwise, assuming a normal monsoon this year, not too much problem on the geopolitical side, I think we could get down to the 5.25 or 5.3% fiscal deficit target for FY25 with the quality of fiscal spending remaining good, the boost on capital expenditure continuing, which could then lead to the private sector capex also improving and increasing much more in a broad-based manner after the elections are over. So that could also support growth, and India could be in a cycle of 3-4 years of very strong growth in this cycle, supported both by public investment and private investment.
Okay, so before we can continue with that discussion, we need to slip into a short break, but stay tuned. We'll be right back. Welcome back. You're watching NDTV Profit. I'm in conversation with Kaushik Das, Rahul Bajoria, and Oradeep Nandi. Now, Rahul, we've been talking about an aggressive but achievable FY25 fiscal deficit target. Given all of that, what do you think the government's key spending priorities will be? And I especially do want to ask you about rural spending. So we've seen mixed trends coming in from the rural areas. Private consumption has also remained tepid this year. Do you think the government is going to be focusing on that specifically and might need to announce more schemes or subsidies for providing more comfort to rural specifically?
Yeah, so I think, it has been an ongoing process of kind of adding to the welfare schemes, both targeted at rural and also at the urban poor, right? I mean, the cash transfer programs. And I think we must acknowledge the role of the states as well, which have introduced a lot of new schemes, particularly in the last couple of years, kind of leveraging the public digital infrastructure, to sort of increase the welfare net in some ways and kind of, particularly targeted towards women in the rural areas. So I think that particular thrust is going to be pretty visible, so a potential increase in the transfers, to particularly to women farmers. The government may kind of consider, sort of holding the fertilizer subsidies and the food subsidies at, a reasonably large level, even though they were rationalized last year. I think this year we should see modest increase in both the numbers. At the same time, they have introduced schemes, targeted towards the tribals, in a few states, from a housing standpoint. So I think there is a very clear bias towards supporting consumption and supporting income, which is largely towards the rural areas. Could there be anything over and above this? I think, it is possible that, a very large part of the capex spending program could be diverted towards railway infrastructure, right, which typically would tend to improve or benefit in an outsized manner the rural and the semi-urban areas of the country in terms of better connectivity and kind of faster connectivity. And so that also should be taken into account when we think of rural spending, that it's not just provisioning of welfare and income support, but also provisioning on infrastructure, which is going to have an impact on the rural and the semi-urban population of the country.
All right. Oradeep, what have you been making of the rural sector so far? Do you think there are signs of recovery, and do you think more needs to be done? If so, picking up from where Rahul left, what are your expectations in terms of any schemes or targeted measures the government may announce for the rural sector?
So look, the rural economy has been sort of performing below its potential. The terms of trade, while they have improved, are still not at sort of historically good levels. So on the rural side, there is weakness, and we are seeing that also in a lot of the high frequency growth indicators that one looks at. And the part of it is also because we've had very erratic monsoons. I mean, the first advance estimates of Kharif crops suggest that there's likely to be a drop in Kharif production this year vis-a-vis last year. So, there is certainly concern on the rural side. The positive side of all of this is that we are looking at lower inflation levels next year vis-a-vis last year, and higher inflation has eaten into people's incomes. Currently, we are seeing a trajectory of lower headline inflation, and headline inflation possibly converging to core inflation at around 4.5-ish levels. So that's the positive side of it. But there's certainly concern on the rural side. Now, the question, of course, is what can the government do about it? And again, we need to understand that this is also an interim budget. We cannot treat this as a budget where huge announcements come through. So I completely take Rahul's point, which is that there is going to be focus on targeted infrastructure. The government already has an income support scheme for farmers. There's crop insurance. There is MGNREGA. That's one figure that everyone looks at, is how much allocation they're going to give to the Rural Employment Guarantee Scheme. So, they don't need to necessarily put in extra pipelines. The pipelines are all there. If they like, they can just put more money through those funnels. So I think it's going to be one of the spending priorities. I think there are other priorities also. There's you need to push consumption, you need to push infra, you need to push manufacturing. But on the agri side, I think that they have the existing mechanisms. The question is how much outlay they sort of push through into these pipes.
Okay, all right. So, moving on, Kaushik, I do want to ask you about the impact of India's inclusion in the bond indices and what do you expect government borrowings to look like in the coming fiscal?
So the bond index inclusion obviously is a very positive news. It is supposed to start from June end, and we are expecting about 25 billion debt inflows to come into India by the end of March 25. So FY25 will see a lot of inflows coming into India from the offshore debt community, and that will also help improve the demand-supply dynamic of bonds. The supply of bonds from the central government side, I think we had about 15.4 trillion INR worth of gross market borrowing last year. It could be slightly lower than that this year, and because fiscal deficit would be reduced, and even after factoring in the redemptions, net market borrowing, the calculations that we have, we think it could be slightly lower than the 15.4 trillion INR worth of gross market borrowing that we saw last year. And then on top of that, the demand side of those bonds, who would want to buy those bonds, obviously that improves because the offshore community would be buying these bonds because of bond index inclusion. So what will happen because of this index inclusion is that over a period of time, and even starting from the next fiscal year, the cost of capital would be reducing, and the pressure on Indian banks to buy that many bonds on the margin would reduce, or even on the RBI to buy bonds and support the market would reduce, because there'll be a new set of investors who would be very keen to buy Indian government bonds. So that's a very good development for the fiscal side. It reduces the cost of capital. Interest rates could come down. That itself could be positive for the private sector to increase their capex and not get crowded out. So bond index inclusion is a very, very positive, development that has happened. And remember, this is just the JP Morgan bond index. It could happen that by the end of this year we could have more announcements about other bond indices like Barclays Bloomberg aggregate, which could also include India. Therefore, in 2025, you could have another 25-30 billion coming into India. So I think the story that India is presenting is that India is doing exceptionally well compared to what we are seeing in other parts of the world. The growth metrics are looking good. Fiscal metrics are looking good. All across the world, people are showing interest to be part of India's capital markets, whether it is equity or bond. And given that the bond market has opened up now and will open up even more, you would see a lot of inflows into India starting in the next fiscal year.
All right. So, picking up from that, Rahul, one last question before we let you go. So, can we still expect government borrowings to remain elevated? Is there any estimate you currently have in mind for what government borrowings are looking like? To close, what I do want to ask is that the last interim budget that we saw presented by this government pretty much turned out to be into more of a full-fledged budget with the kind of announcements and the nature of some of those announcements that had come in. Do you think there's any scope for surprises on that front this time as well?
So I think taking the second question first, I think the budget will be a statement of intent. It will try to provide a direction in terms of what this government, if re-elected, would kind of try to do in the next couple of years. What is the broader direction of fiscal consolidation? What is the priorities as far as spending is concerned, both in infra and in terms of the welfare schemes. So I would look for some narrative setting to be done, even in the garb of an interim budget, right? And that will get followed on in the full budget in the month of July. In terms of the gross borrowing itself, I think 15.5 trillion INR is what we are looking at, so slightly above what Kaushik has in mind. But I would say that a number, whether it's large or small, is a function of demand. And we have seen bond yields being in reasonably good demand. Bonds being in reasonably good demand, and that's reflected in the yields. And you have visibility of flows, whether it was say insurance sector last year, this year it could be the foreign portfolio investors. There's obviously reasonably strong growth in deposits. So there are factors which will support yields. You could also see the RBI starting to ease monetary policy at the margin. We expect the first cuts to come through from the June MPC meeting now. And so from that perspective, I think there will be reasonable amount of demand, both for, in terms of quantum and in terms of duration, which should provide a fair amount of support to the fixed income, side of the market this particular year.
Well, we're running out of time and we'll have to close on that note, but thank you so very much for taking time out. We'll stay in touch with you over the next few days for your thoughts and views on the budget. Thank you so much. Stay tuned to NDTV Profit as we continue our pre-budget and post-budget coverage.